As I saw it, one of the plans out there now is a 1/10 of 1% financial transaction tax. Which of these proposals is furthest along or gaining the most traction? Let's start there.
Hey, Tyler, and thanks for having me. Well, there's been various proposals out there between 0.1 and 0.5%. I think the one that's holding or getting the most traction right now is the 0.1% tax. But what we're looking at here is this is being billed by its proponents as a Wall Street tax, right? High frequency trading and those types of bigger traders. But in reality, it's a Main Street tax. And I say that because if you look at the corporate or the retirement savings plans that are out there, there's about 100 million Americans that are involved in these savings plans. 2/3 of those participants, they make $100,000 or less in income. 1/3 of those folks make $50,000 or less in income.
So let me interrupt you. Excuse me, just a minute, because I think I get your main point here, but I want to make the nexus between how the transaction tax leaps over the bridge and contaminates or gets into a 401k, an IRA, a 403b. Is it because every time I put in my biweekly contribution, 1/10 of 1% of that contribution would be taxed because it would be regarded as a transaction as opposed to the trading that I might do in that account, which is comparatively rare for most people?
That's just it. That's exactly right. So you have any financial transaction, and that's really the gist of this. So your biweekly contributions. Another big area, Tyler, within retirement plans look at target date funds as an investment, right? In 2006, the Pension Protection Act allowed for automatic enrollment. You could move forward with auto enrollment. That's basically letting your participants, you're enrolling them, they have an opportunity to opt out. Well, the Department of Labor said you can go ahead and do this, but it has to be those investments have to be within a qualified default investment alternative or a QDIA. Well, the qualified default investment alternative of choice right now is target date funds. There's about 35% of total retirement plan assets are invested in target date funds. And a target date fund is basically a fund of funds that go along with you towards your retirement age.
Right.
Okay. Some of those funds, Tyler, there's different money managers. Some rebalance quarterly, some rebalance monthly. So every time that participant has their account rebalance, an additional 0.1 or 0.5.
We're running out of time here. I want you to bottom line me. The effect of this 1/10 of 1% tax on transactions in a retirement account would be what over a typical investor's investment lifetime? How much money would I lose?
Great question. You lose between $45,000 to $70,000, which is equate to 2 to 3 years of working, right? So it's
substantial. That's because you would be compounding on a smaller dollar amount, correct?
That's correct.
Shepard Smith here. Thanks for watching CNBC on YouTube.